One of the tools of wealth creation is debt. And the first thing I want to explain to you is that despite the marketing activities of major banks, borrowing money is not a partnership. Think of it this way. When you go in to borrow money, your job is to borrow as much money as is prudent, to pay as little for it from an interest perspective as possible, and to provide as little security as possible, to put as little amount of your wealth, existing wealth, at risk as possible. The person sitting opposite you, representing the borrower, their job is to sell you as much money as is possible, to charge you as high an interest rate as possible, and to take as great a security as possible. That's not a partnership. That's a tug of war. It's 5 times easier to save money than it is to make money. And one of the ways you should be saving money on a regular basis is reviewing the supplier of money in the first place. Most of us don't think of money as a commodity. Most business owners will review the suppliers of their raw materials, will review the suppliers of their employees, will review suppliers across their board all of the time, but rarely, if ever, review the suppliers of money. Banks and other financial institutions are simply places where you buy and sell money, just like you buy and sell supplies for your business, or you buy and sell goods for your home. You need to review it and need to review it regularly. Introduce competition for your business, because when you do, the only winner is you. Do you know the true costs of borrowing money? If you're going to use borrowing to help in your wealth creation efforts, it's vitally important that you understand the true costs of that loan, whatever loan it might be. And there's more than interest rate to take into account here. Interest rate, of course, contributes to cost, but so too do the following: the rate at which the bank apply capital to your loan, the term over which you repay, time value of money, whether you get tax relief or not on the interest payments, the insurance that you have to pay to protect the bank against your death or disability, and finally the fees you have to pay to process the application. These are all costs that contribute to your loan, and you must take them into account when calculating the costs of debt. Are you paying too much money for your loans? The cost of your finance will majorly impact on how successful that finance is in helping you to generate wealth. And because this is true, when you come to borrow money, you need to shop around. If one bank will lend you money, it's pretty certain that every bank will lend you money, because they're all using the same algorithms. And banks only care about 2 things. They care about ability to repay, and they care about the security you offer them. So what can they flog off if you don't give them back the money to get their money back? Just to give you a quick example, I looked on a comparison website today at in this case, a home loan, €350,000 over 25 years. And I simply looked at the pillar banks, the least expensive loan versus the most expensive loan over that period. The difference is €47,000. That's €1,880 a year. Shop around. You've heard me talk about shopping around for debt. It'll reduce the costs. And I don't just mean when you're raising the debt in the first instance. I mean shop around after you've raised the debt and after certain times have passed. If you think about it this way, if you have an existing $500,000 commercial loan in your business, or a $500,000 loan for investments, when you borrowed that money, you were a different person. Your income was different. The value of the asset available for security was different. And those are things that should be contributing to the cost of loans. If you have a $500,000 loan today, a commercial loan, let's say at 7% over 15 years, that's going to cost you $882,000 to repay. If on a review you can reduce the interest rate to 1%, by 1% to 6%, that's going to cost you $772,000 to repay. That's a saving of $51,000 and a few bob over 15 years, or a saving of €3,400 a year. Shop around. not only when you raise finance first, but review the suppliers of that finance on a regular basis. When I talk about using other people's money to create wealth, what I mean is borrowing in essence. And one of the things, if you think about it this way, it's a very simple piece of arithmetic. If you can borrow money at one interest rate and then invest it at a higher interest rate, you are making money with other people's money. But the question is, what does the borrowing really cost you? And that's vitally important. You have to run your arithmetic. You have to take all costs into account. And if you cannot do that for yourself, hire somebody to do it for you. It will save you a huge amount of money in the longer term.